So we're going to start off with order blocks, and a good example of a order block was this week. So if we highlight this week, we're going to go to Sunday and then Friday. So this was this week's price action. If we quickly highlight why we rejected this week, we obviously are going to be starting off of the high time frame. So we have a high time frame PD array, which is our BISI, bullish fair value gap. And let's mark this out real quick. Alright, so we obviously had a rejection of our BISI and we displaced higher. But where on this chart can we see a liquidity sweep and then obviously some down close candles on this in this week's price action and then displacement above it? And it's going to be, that was a rhetorical question, it's going to be right here. So we have these down close candles and we have a liquidity sweep, which would be here. Okay, so we sweep liquidity, we head higher, and for this to be our order block, this candle would have to displace. I know, Awakening, you know the order block, how to predict an order block, and I've mentioned this in our live classes. How to predict an order block. For example, in a bullish scenario, you would want to have a series of down close candles, and then if we're gonna have a move higher, for example, this candle right here, this candle would have to displace. You would want to see a candle like this. You would want to see energy behind the candle, not just a little poke above. So, and then once you get displacement above, these two candles would be an order block. But since we didn't get displacement, we headed lower to take even lower liquidity, eventually rebalancing, redelivering this fair value gap, and then eventually heading higher. Now, okay, so now we got our down close candles with our displacement. Where would our entry be? And this is obviously a higher time frame example, but this is just the bullish time is fractal. You can use the same example on the 5 minute, the 3 minute, the 2 minute, the 1 minute. But this is just a good example that I found in my back testing. So our entry would be on this candle right here, because not only do we have this order block, but I'm not just going to blindly long the order block. It pairs up with a fair value gap right there. So we have this candle, this displacement candle, from the first candle, the high, to the third candle, the low. The second candle is going to be our fair value gap. And you're not just going to blindly long the fair value gap, you're going to pair it with the order block. And if we pair it with this order block, that would be our entry right there. To the tick. So now that we have now that we have our bullish example, we're gonna, if you guys are taking notes, this is gonna be your criteria for an order block. You're gonna want to see you want to see it. Yeah, I'm gonna mute you up, Bahas, if you don't mind, big dog. Unless you want to mute up yourself, just so I don't have to mute you. All right. Anyways, this is gonna be your criteria for an order block. So you're gonna want to be coming off of support or resistance, and this is all theoretical. There's really no such thing as support or resistance, but for example here, if I highlight it, we had a level of resistance here since market came down, took liquidity, came higher, didn't want to displace above here, so we have theoretical resistance here. And then after that, we want to take out a higher or low. So for a bullish example, we take out this low, which it would be right there. We took out that low. This would meet our second entry, part of our criteria for our order block setup. And then For rule number three, we want to see displacement, and this is the important part. You want to see displacement or energy behind the move after. And this is how you can predict the order block. So you have your down close candles, and then you don't want to see little candles like this all the way up. You want to see big, very broad candles like this right here that state I want the price, that price wants to go head higher. So that's step number three. So step one is support or resistance coming off of one of these. Step two is a high or a low to be swept or to be taken. Step three is displacement above your order block or order blocks because each candle is an order block. And then step four would be a return into it. And this can be if, for example, in a candle like this where most of it is body, the entry would be on the open or on the wick. Okay, so the wick, why would it be on the wick and why would it be on the body? So if the wick lines up with a fair value gap, you have reason to enter on the wick. If your wick, for example, let me see if I can find an example here. Um, for example, here, this isn't a valid order block, but for example, here we have the wick of our candle. This candle right here, the bottom of the wick. Does it line up with the fair value gap? No. So you wouldn't enter off of the wick of this order block, even though it does play out, but this could return into, like, let's say this is your wick. I would prefer to enter off of this order block wick because it lines up with this fair value gap opposed to this one. And it's all about probabilities, so you would want to be going for the high probable setup. So that's the difference between entering off of a wick and off of a body. So, and step number, oh, and also I wanted to mention this, and this is also important. So let's say your order block has a long wick and it's very little body behind it. Then you would take the 50% of your order block. So there's different ways of doing it. You can do the 50% of just the wick. You could do the 50% of the entire candle, or you could do the 50% of the body only. And each one has its own scenario, but I've honestly made, I've made really good plays with the 50% of the wicks on an order block. And it depends like which wick is longer. For example, this wick is longer. So the 50% of this wick will be acting as a gap for price. So when we retrace into it, you would want to see it respect it to head lower. So those are different entry types on an order block. So just to review them, it's going to be the wick, the top of the top or the bottom of the wick, and only use this entry if it lines up with the PD array, if it lines up with the volume imbalance, if it lines up with a fair value gap, if it lines up with a breaker block. So that would only be when it pairs up with another PD array. That would be your wick entry. Your open entry is your high probability one. This one works even without another fair value gap or another PD array to support it. This is your go-to, the open of the candle, whether it's bullish or bearish candle. And then your third entry type would be the 50% or the mean threshold of the order block, whether it's the wick or the body. So that would be our bullish example for an order block. Do you guys have any questions so far? Do you guys understand everything? Give me a thumbs up if we're good to continue. If we're good to move on, just give me a thumbs up in general chat. Alright. Awakening's good. Ross and Lambo, you guys good? We good to move on? I will take the silence as a yes. Alright, so we're going to be moving on to a bearish example of an order block. And this is also going to be on Monday's price action, but we're going to be moving on to the 3-minute chart. Was it on Monday? Monday's over here. Monday's right here. Here we go. Alright, so a bearish example of an order block is going to be vice versa of what we talked about. So you would want to see displacement lower. So for example, if I draw it out right here really quickly, so we have our up close candles like this, and then we have displacement lower, okay? And then you would want to see a retracement into your order block, which would be your series of up close candles, which would be all of these right here. That would be your order blocks. And then if those line up with a PD array, for example, a fair value gap, you can pair that up with a fair value gap for entry. So just vice versa of what we just talked about of the bullish example. So really quickly, I'm going to look for our, okay. Alright, so this is Monday's price action, and Monday was a pretty bearish day compared to Tuesday, Wednesday, Thursday, Friday, which we had an expansion higher. So on Monday, we had our opening range, which was this Judas swing here. I'm just going to quickly recap Monday. So we had these up close candles here. This was our Judas. And then we had I remember we took out Asian highs, which was here. As you can see, we took out Asian highs. Once we took out Asia highs, we expanded lower. So now that we have our Judas, and then now that we have our bias set for the day, we have a bearish bias. We're going to be looking for our bearish entry. So there are a few, but we're going to be choosing our PM session silver bullet, which is from 11 my time to, no, actually, we're not going to be doing that. We're going to be choosing our AM session. It was right before the AM session close. So from 9:30, this is going to be your AM session right here. And then we're going to highlight the PM session. So AM session right here. And then we have our PM session right here. And then lunch is going to be this little consolidation right here in the middle. So AM session typically sets the trend for the day, and PM session there's different models you can follow. So PM session may have the trend continuation, or if we have liquidity left at the highs, for example, we swept liquidity at the highs, so obviously we would want to target the lows. So for the PM session, just a bearish order block example here is if we take these series of up close candles, or these series of up close candles. Obviously, if we take these up close candles, we had a rejection here. Or if we take these up close candles, we had a rejection here, here, and here. But specifically, if we take the last up close candle of this continuation, we would want to pair that up with a fair value gap.
No. It's in the fridge.
So
Yeah, it's in the.
So in this case, you would want to obviously pair up your PD array with a stacked PD array. So if in this case we have a bearish example of an order block with a fair value gap. So we do have a few entries here. So we have this entry, which rewards you That's 9 points right there. We have this entry rewards you 8 points. Or if you really, really wanted, to be a degen and enter on the last order block, you would get perfect entry. That one rewards you 17 points. But if you're targeting the low-hanging fruit, then you're just getting 11 points, which is insane, still insane. So this is a bearish order block example. So quickly to review it, we already went over for those of you that just joined, we already went over a bullish order block example, and we just went over a bearish order block example just now. So your steps for a order block in any direction, bullish or bearish, are going to be these. If you want to write these down, you're going to be coming off of either support, theoretical support, or resistance. So this can be bullish or bearish. You want to be sweeping a high or a low. This would take out your liquidity, or this would be your stop hunt raid. So for example, in this scenario, we took out this low, headed higher, and I guess you can say this consecutive series of up close candles acted as an order block. And then step 3 is, okay, yeah, you have these up close candles here, but when do you see displacement? After which up close candle? After this one, right? So this one would be your best high probable order block entry, since we have this displacement lower right after it. Step 4 would be a return into it. So if we mark out this order block right here, which is the one that creates displacement, a return into this order block would be here. That would be your entry. Stops above this swing high. Four-point stop, targeting low-hanging fruit. Call it a day right there. So those are your steps for an order block. And if you guys did join a little bit late, this is all recorded, by the way, so I'll be posting this up on YouTube after the class for you guys to review if you guys didn't miss the beginning. So that was our order block. So we're going to be moving on to, I don't want to bore you guys too much. This is going to be um, a bit of a long one since we're going over bullish and bearish examples. But we just finished the order block. We're going to be going over the breaker block now. Breaker block is, in my opinion, is very high, like it's super high probability. So we're going to be going over that. We went over that last week, but we didn't record the class, so I just want to give it a quick review, just so we refresh our minds before starting the week. So bullish example of a breaker block. Let's go on the 1 hour for this one. And this one was actually in my analysis. If you guys go on Discord and you go to KISS analysis, you can actually see June 27th, not this recording, but the second recording, where it has like 4 little fire reactions. This one actually talks about our breaker block that I was giving analysis on. You can watch that. It's 3 minutes long. It's not too long, but I was basically saying, you don't have to watch right now. I was basically saying, so we have, if you go on the 4 hour, okay, actually let's go on the stay on the 1 hour, just to make it simple. If we go on the 1 hour, we have obviously this move higher, and I chose this fair value gap on the 1 hour, but if we really narrow it down, it's going to be that fair value gap right there. So if you guys want the steps for a breaker block, it's going to be 1, you're going to want to have a low. So let me quickly. So you're going to want to have a low. In this case, for a bullish example, it's going to be a low. Obviously, for a bearish example, it's going to be vice versa. So you're going to want to have a low. And your second step is going to be obviously, in this case, it's a bullish example. So you're going to want to have a lower low. And this is the part that a lot of us miss right here. And this is the sauce right here. You want your lower low to tap into a high time frame PD array. And this is the sauce. I just gave you guys a sauce. Your lower low must tap into a high time frame PD array. Doesn't matter which PD array, could be a fair value gap, could be an order block, but this high time frame PD array must support price. Okay? So once your lower low on a lower time frame taps into a higher time frame PD array, this lower low will act as theoretical support, or this will be the low to send price higher. Okay, so step 3 would be tapping into a high time frame PD array. So in this case, it was our 1 hour fair value gap. And step 4 is obviously displacement above which high? It would be this high right here. Let me make that a little neater. Okay, so we have our low, move higher, no displacement on this low. So as you can see, we have a low here, and then we have a lower low that taps into this high time frame PD array. No displacement. Okay, we return lower into another high time frame PD array, and this one we see displacement, obviously, after a little retracement, but I believe all of this was an overnight move right here. Yeah, it was. So this was Asia session and this was London. And then what happens at indices open? We displace higher above this swing high, and if we mark that out in time, this would be your entry. And obviously step 4 would be a retracement back into your breaker block. So there's two kinds of entries for a breaker block. There is a here, let me clean up this chart. All right. So there's two types of entries for a breaker block. You have your aggressive entry, meaning I want to get in right now. I don't care about the spread. I want to get in like ASAP. I'm trying to make my money dip. So your entry would be on the close above the swing high. So if we take this swing high right here, let me turn on my magnet. Okay, there you go. If we take this swing high, we draw it out in time, your entry would be here on this candle's close. That would be your instant entry. As soon as it closes, boom, you're in. And this play rewards you with a good, I mean, obviously you're not going to catch the top, but 17 points. But if you're, I always preach, I don't care who you are, I always preach 5 points. If you can get 5 points in the market, you're done for the day. Especially as a new ICT trader, you want to be going for 10 or 20, especially on ES. So 5 points easily handled right here. So that's your aggressive entry. Now your more conservative entry is your retracement back into your breaker block. So in essence, your breaker block is this entire move here. This is your entire breaker block. But you want to be pinpointing the sensitive areas, which are going to be either the wick or the open. So if we want to get really nitty gritty with it, we could choose the open, and that's like literally to the tick right here. But since our wick lines up with a fair value gap, and obviously this is in hindsight, so we can go back and say, okay, I went into the open, but if I'm going to be realistic, I probably would have entered off of the wick because it lines up with a fair value gap. You enter there, target, your low-hanging fruit for either all of your position or 80% of it, and you could leave runners if you want. But as you can see here, if we zoom in, if our entry is here and our exit is at this high, you would exit on this move up straight to target. And that is a bullish breaker example. So if we want to review that really quickly, our bullish breaker example entry drill, and this is going to be for the bullish example. So you're going to want a low. Okay, in this case we have a low. That's step 1. Step 2 is a lower low, clearing the low's liquidity. So you want the lower low to clear this low's liquidity. And this lower low, and this is the important part, this lower low must tap into, and this is step 4, must tap into a high time frame PD array. And for me, high time frame is 1 hour, 4 hour, daily, weekly, monthly. The 15 minute, a lot of people consider it high time frame, but uh, I feel like it's just in the middle. It can work, but I think 1 hour is is obviously stronger than the 15 minute. So I would say 1 hour qualifies as high time frame. So you want your lower low, and just for reference, this fair value gap here is on every single time frame. It's on the 4 hour, it's on the daily. So you want your high time frame PD array to line up on most of the high time frames, not just one. So that would be step 4, and then obviously step 5 is a displacement above the swing high that was created. And for your entry, which would be step 6 and 7, step 6 would be aggressive entry. Sorry about that. Step 6 would be your aggressive entry, which is a close above the swing high. Or step 7 would be your conservative entry, which is a retracement back into the breaker block. So that would be your bullish example. For our bearish example, we're going to be going over to, it's also on the high time frame. So we're going to be going over to, I believe this was 2 weeks ago. So we're going to be going over the bearish example. So it's going to be literally the same thing, but vice versa. Okay, so you're in this case, you're going to want a high. Okay, you're going to want a high, and then you're going to want a higher high, obviously clearing the highest liquidity. Okay, and as we all know, the higher high must tap into a high time frame PD array, which obviously on the ESU contract you can't see previous data. But if I would bet on it, I'd say this obviously tapped into a high time frame PD array considering this move lower. So you would want a high time frame PD array touch here. And where would our swing low be this time? So since this is a bearish example, you want to be looking at the swing low. That would be your swing low. Okay. And remember our entries. Our entries were aggressive entry or conservative entry. So if you want an aggressive entry, you could have entered off of the close of this candle. You would have gotten a little bit of retracement, and eventually you probably would have gotten a nice, your 5 points, you know. But this is obviously higher time frame. This is just an example. Time is fractal, so this play can happen on the 5, 3, 2, 1. Or, or you can wait for your conservative entry, which is a retracement. In this case, you got two retracements actually here. So if we zoom in, let's actually zoom into this and let's dissect this. You got two retracements. So there was you could have entered off of the close. You could have done your aggressive retracement, which as you can see here, we close and we instantly retrace into our breaker. That could have been your entry. Or you could have waited for obviously, you know, some type of swing to form, liquidity to form, and then a retracement, which I would probably prefer this one. As you can see here, we retraced back into it like we did on this other example, quite literally to the tick. So on this example, we had a low, lower low. This was your high. If we draw that out in time, retraced right into it here. Bearish example, we had a high, a higher high, retraced into it here, eventually heading lower. So that is your breaker, bullish, and bearish example. And as a matter of fact, speaking of breakers, I recommend you all after the class to watch ICT's new video. I got like 10 minutes into it. He just released it like an hour ago. Um, and it talks about breakers. It's actually advanced. Here, let me real quickly. Advanced theory on ICT breaker. So I recommend you guys to watch this video. It's an hour long. So I'm actually going to finish this video after the class. So just keep that in mind. So with that in mind, we're going to be going back to our charts. So if did you guys get the breaker Let me know in general chat if you guys have any questions. If not, give me a thumbs up so we can move on to the mitigation block. This is going to be our last PD array we're going to be going over. I don't want to take too much of your guys' Sunday. If you guys are ready to move on, give me a thumbs up. Could you go over the stop loss on these? Yes, of course, of course. Okay, so this is obviously higher time frame, but we're just going to pretend this is the 5 minute. So if you're on the 5 minute time frame, and this is the 1 hour, obviously. So if you're on the 5 minute time frame, there you got two options for a stop loss on these. You could choose a five. So I always recommend a 5 point stop loss. I just changed my chart here. There you go. All right. I always recommend either a 5 point stop loss, and 5 points is very generous on ES. It's very, very generous. Or, for example, in this case, since you have your higher high here, typically what the market will do is it'll form some type of consolidation after taking this higher high, and it won't automatically displace lower. So in this case, we have this consolidation here, and let's just say your 5 points was at the swing high. If you have your higher high up here, and this was your 5 points, I would bet on it that price has no reason to even head over this swing high or over the consolidation. Because what ICT says is after consolidation, we have distribution. After distribution, we have a retracement and then expansion. So after this consolidation, we obviously have distribution. We have a retracement and then expansion. So if your stop loss is here, or if your stop loss is here, I can bet on it. It won't have and that's the good thing about the breaker. There is no reason for it to come up to here. Why? Because we already took liquidity at this high. So if we've already taken stops here, there's no reason for it to come up and take out this higher high. And that's the beauty of the breaker. So since we already have a higher high taken, damn, if we already have a higher high taken, your stop loss should be comfortable around either this swing high or the higher high. And if the higher high is like 7 points or 8 points, it's not even worth it. Just leave it at 5. If your higher high is too high, then I would just keep it at 5. Does that make sense? All right, for sure, for sure. Yeah, so 5 point stop loss, 5 point take profit is how I started trading, and it's very, very useful. Eventually, once you have to slowly graduate from 5 points eventually. So eventually you'll start to like get the hang of a 5 point stop loss, 7 point take profit, or even you could even go 2 to 1 to 10 points. But that obviously takes time. You can't go straight to it from 5 to 10. You have to go 5, 6, 7, from 7 to 8, 8 to 9, and then eventually you'll reach 10. And I feel like, like in this case, let's say this is a 1 to 1, but let's say you were targeting this swing low right here. It probably would have hit your 5 points, and you would probably still be in full position here. You get this retracement, and then you get expansion. So in this retracement, you probably would have gotten emotional, like, damn, I should have taken profit down here. So then you exit position here. So it just takes time. Like with time, you will eventually start like come to the realization that, okay, I'll take partials at 5 points and leave, you know, the rest of my runners to my second profit target. And that's the beauty of partials. Awakening and we've talked about partials, and you can catch crazy, crazy moves with partials. You take 80% of your position off at 5 points, and let's just say you take off 5 points here. Let's say you have 10 contracts on ES, and your first take profit is at 5 points. So you take off 8, here, and then maybe on this low-hanging fruit, you take off one. So now you have 9 contracts out of the gate. You have one contract left. Let's say this contract was your like, stops at break even. You don't care where this goes.
الشمت شوية عن البرتاشو.
All right, my bad. Um, let's just say this last contract stops her at break even, the risk-free trade. You don't care where it goes. So you can even say, like, heck, I might just leave it, let it run to here. Catch this nasty move. Insane. And that's the beauty of partials. You can catch insane moves. So you guys can play around with partials. You guys can do full position. It's up to you. So yeah, that was a quick little sauce on how to use partials. All right, so are we ready to move on to mitigation blocks? If you guys are taking notes, I'll give you a quick second to finish up, and we'll move on to mitigation blocks. All right, so we're going to be going over bullish. This is going to be our last PD array. It's going to be mitigation blocks, bullish and bearish examples. So going back to this week's price action, let's go to the 5-minute, and we're going to go to Wednesday. All right, so we have Wednesday's trading, which was from obviously 9:30 to market close. But this is just an example, just so you guys could get familiar with mitigation blocks. So a mitigation block is the continuation, or I would say a breaker block comes first, and then a mitigation block follows. So think of it this way. We have a breaker block, so we have our low, our lower low, and then typically we like do something like this, and then we just place higher above our breaker block. So we have our breaker block here. This is our breaker, since we took liquidity here. We took liquidity, and our breaker is up here. But where's our mitigation block? Our mitigation block is here. Now, what makes a mitigation block a mitigation block? So remember this pattern. The pattern for a breaker is a low and then a lower low, right? So we take liquidity. But the pattern for a mitigation block, and this is the pattern right here. This is the sauce. Listen carefully. Breaker, swing low taken. Mitigation block, failed swing low. Okay? So after our breaker, we have obviously a swing high, and then we have a retracement. And then you want to see a failed swing low after liquidity is taken. And then this high will be our mitigation block that will send price higher. So if we take this example, we have our, this is a bit botched. You would want to see it look like this. But we didn't get that lower low. But this is just an example of a mitigation block. So this is the perfect example right here. You want to see the breaker and then the mitigation block. But if we take this failed swing low, since it's a smaller one, you could take this one because it's a failed swing low, but I'm pretty sure there was SMT here. If I go to NQ and ES, I'm pretty sure NQ took this low. That's why ES didn't. And then this is your failed swing low. So then what would be your mitigation block? It would be here. There, or you could even do wick to wick. So you get your mitigation block, and you would either want to see, you could take your bodies or the candle, but you would want to see displacement after. So you have your displacement after. So if we disregard this diagram here, so we have our, obviously we have this form, feld swing low, okay, displacement, this entire range right here, like we highlighted, would be this entire thing actually. This move lower, which is your feld swing low, that's your mitigation block. So you have a few entries, but as you can see, we hold it actually. We hold it there and we hold it here. But where would our sensitive areas be? And you don't, it's not recommended to trade a mitigation block solely off of the mitigation block. You would want to see it pair up with another PD array. So if we really dig deep, we can see that we have a fair value gap here. And you would take entry where they both line up, which would be right there. That would be your entry, and you can target your low-hanging fruit, which would be here, or you could go here. And on the 5-minute chart, that's a nice 7 points, or a nice 13 points. But as you can see at indices open, we come down lower, and we actually take this liquidity. So this actually looks more like a breaker play right here. So we have our low, our lower low, tapping into a high time frame PD array. So I'm pretty sure if we go on the 1 hour and we look at this mitigation block, it's a feld swing low. I could see it. But that's why we go on the 15-minute. Okay, on the 15-minute, see, this is why I said previously where the 15-minute, I wouldn't consider it a high time frame unless it's necessary. So as we can see here, the 15-minute, we have our mitigation block, which would be these down close candles here. So in this case, we have our breaker. This is actually a perfect diagram right here. Breaker, right here, low, lower low. We head higher. Then this is our secondary mitigation block. You can go wick to wick, or you can just do body to body. That lines up with a fair value gap right there on the 15-minute. If we go on the lower time frame, this is our entry would be at that shaded area right there. If you enter there, stop at 5 points, your stop would be all the way down here. Obviously it wasn't tapped, and you could target your low-hanging fruit, which is this up here for 10 points. So that is actually a better example actually than this one. So this was the mitigation block that created the breaker block, that created the secondary mitigation block, that created your entry. So you see how this was Wednesday's trading, and then the Thursday right after, we actually created this literally the same setup. So these setups are provided every single day. So that was a bullish example, and let's actually go to a bearish example. Actually, really quickly, if you guys want to write this down, if you guys want to write down the structured steps for a mitigation block, and this is kind of like a little review of what you want to be looking for. So 3 steps, very simple. You want to see the pattern, which is a feld swing low. Okay. So you want to see a feld swing low. So this low didn't take out this low, feld swing low. Obviously coming off of a higher low, which in this case we came off of a low right here. And this is where you would want to see your breaker play. So we come off of a low right here. Then we have our pattern, feld swing low. And then you want to, step 3 is overlapping. And this is, like I said before, you don't want to take the mitigation block solely off of the mitigation block. You want to take the mitigation block in confluence with another PD array. So in this case, if we have like a fair value gap here, that's perfect entry. So there's two setups here in one diagram. You could use your breaker diagram, or you could use your mitigation block diagram. Two plays, two different types of entries. Only difference is the pattern. One is a felt swing low, one actually takes the low. So 3 steps, pretty simple. Alrighty, so going off to our bearish example, it's gonna be on Monday. On the 5 minute. Alrighty. So always keep in mind when looking at the mitigation block, always keep in mind the breaker block. So if you guys don't see it yet, we have our high, our higher high, and then we have, what do we see here? A failed swing low. Okay. And then we have a retracement into either here or here into that swing low. So let me actually make this a bit more useful for you guys. So we have our high, higher high. Okay, that's our breaker setup. This would be your breaker entry. But we're not going to be waiting all the way to these lows. So if we want to entry now, we're going to be looking at our mitigation block, which is going to be right here. Okay. This is your failed swing low because we don't take out this high. I'm sorry, failed swing high. So this high, then we have a failed swing high. Okay. Then we get a retracement into this mitigation block. And what do we see? Remember step 3? We want to see overlapping. So we have a fair value gap with a mitigation block. So that would be your entry. Either you can enter, there's 2 entries here. If we really zoom in, look what this candle does. Right there. Or you could get the retracement right there. So this candle actually gives you 8 points. This retracement, if you enter at that same area, gives you about 13. Both really good plays. 8 points and 13 points are really good on ES. So that is your bearish example. So typically you see the breaker form first, and then you see the mitigation block form right after. And that is going to conclude our class. That was a bullish and bearish example of the order block. That was a bullish and bearish example of the breaker and the mitigation block. And if you guys have any questions, let me know now. But I do want to give you guys homework right before we leave. So I want you guys to find one of these setups, any if you want, order block, breaker, or a mitigation block, any of these setups, and backtest it. And once you guys backtest it, send it to the member backtesting channel, and I'll review it, or any of us can review it. But yeah, if you guys have any questions right now, let me know. And if not, that's gonna conclude our class. I'm gonna be right after this class. I'm actually gonna start making it right now, next week's class. So if you guys wanna just go ahead and press interested on that so you get a notification when we start that class. But that's going to conclude our class, and thank you guys for joining. I'll be posting this on YouTube so you guys can go back and watch it. But thank you guys for joining, and I hope you guys have a nice rest of the week. I will see you guys. So, quick reminder before we leave. Tomorrow, Monday, is going to be a short day for the markets, so low volume. Tuesday is going to be market closed. It's going to be a July 4th. Wednesday, remember guys what we talked about? Search and destroy profile typically happens after a bank holiday. So Wednesday, I will most likely be trading the PM session. If you guys want to tune in for that, we can trade the PM session. That's going to start at 1:30 Eastern. So we can trade that on Wednesday. So before we leave, guys, I just want to say thank you for joining. If you guys did enjoy anything, you know, if you guys did enjoy anything or learn anything, I'm glad you guys did. But I will catch you guys Wednesday for the PM session. Um, if we do, God willing, if we do see each other. But with that being said, I will see you guys Wednesday, and make sure you guys press interested on the event I'm about to create. Of course, Ross, I'll see you Awakening. I'll see you Karen. I'll see you Ross, and thank you guys for joining. Peace.